take a look at this chart, the 10-year yield right now. Actually, we'll do the 10-year first. But we are seeing it at session highs. If we pull it up, there we go. The 10-year note at session highs. So then take a look at the yield, the inverse relationship there. And this is all on the back of China. Joe, what do you think?
Well, you know, I think, again, from a more macro standpoint, I think the flight away from treasuries is going to bring some capital into the equities market itself. The question is, where does it go? And I think it has to go defensively because there are still a tremendous amount of headwinds out there.
The other question, Melissa, really quickly is, you know, who else is going to finance our deficit? You know, there's a lot of people that say without the marginal Chinese buyer, U.S. rates back up just because, you know, you clearly don't have that same demand. So watch that. That is a big implication. Who's going to be the next guy that finances our deficit if China steps away?
All right, and you know, that is a concern of our next guest, actually, Tim. Peter Schiff has been saying for years that letting the yuan float would be a good thing for China, bad thing for the U.S. Peter, nice to have you with us.
Thanks for having me.
First question here for you is, why don't we start off with that Treasury question and the point that Tim raises. Who will buy our Treasuries if China steps out of the market?
The Federal Reserve. I mean, that's the problem. They're going to be the last buyer. That's why you don't want to own dollars. You know, we've received a huge subsidy and still do from the Chinese. That subsidy is being withdrawn. I think people are going to be surprised by the magnitude and the speed with which the RMB appreciates. I think initially it'll be slow, but as the Chinese government begins to comprehend the full benefit to their economy of a stronger RMB, I think they will loosen the reins and the currency will rise more rapidly. And for America, that means higher prices for consumers.
What does more rapidly mean to you, Peter? I mean, more than 5% appreciation? Because that's what's pretty much anticipated.
Yeah, much more than that. I mean, much more. I mean, the currency needs to go up dramatically to reflect the true purchasing power or the true productivity of Chinese workers. And, you know, it's going to pull the rug out from under our phony economy.
Hey, Peter, it's Brian Kelly. What I see when I see this, I see money flowing into China, which actually could put a bid into treasuries. I think the market's got it wrong here. How do you see it?
Well, I don't know where you get a bid from. I mean, if the Chinese government...
You get a bid from the fact that now that China is becoming more flexible, the yuan's becoming more flexible, and companies want to get that domestic demand, they're going to start investing in China. It's a little easier to get in there. That actually means that dollars are coming in, and they're going to have to recycle those dollars.
No, that if they're going to invest more in Chinese production, they don't have to buy as many treasuries. And remember, the reason that the Chinese government is buying so many treasuries
have to buy them because money's going into them.
No, you got it wrong. Look, the reason
I think the market has it wrong.
Hold on, let's let Peter talk.
All right.
Okay, go ahead.
The reason that China's been buying so many treasuries is because they've had to recycle all the dollars that they purchased to prop up our currency and suppress their own. But as the Chinese allow the RMB to appreciate, they don't have to buy as many dollars. They don't have to buy as many treasuries. And so we have to find somebody else, but there is nobody else. There's just the Fed.
The assumption there is that the rate of inflow into China remains the same. I think that the rate of inflow may increase, which will offset that treasury buy or treasury less.
If the Chinese are spending their money purchasing things, they don't have as much money to buy treasuries. If they're investing their savings in domestic capacity, they can't lend it to us. They can't simultaneously spend and loan the same money.
All right, good explanation of both sides of this debate. But Tim, I know you have a question out there.
Well, what I would say, Peter, is you know, to what extent is Chinese economy now ready to have the yuan appreciate that rapidly? I mean, these guys, you know, if they're making that kind of a sudden shift, doesn't that tell you something about the global economy that's actually very positive about the U.S.?
Well, they are very ready. You know, if you look at the problems in China right now, it's inflation. You're getting striking workers who are protesting inflation. Inflation in China is a direct result of the currency peg. And people think that China has an export economy. They don't. They have a production economy. If they consume their production rather than export it to us, they will be much better off because they will be able to reap the rewards of their own productivity. Right now, we're getting all the rewards. All we're doing is giving them pieces of paper.
They're not going to flip the switch overnight, though. There's no way.
Got to leave it there. Peter Schiff, our thanks to you. Welcome back to the Halftime Report. We are losing some steam in the rally, the China-based rally. Take a look at the markets. The markets are at session lows right now. It does look like we are starting to lose technology. The Nasdaq is up by about 0.1%. The dollar, we should note, at the highs of the session. Treasuries, as we had noted earlier, also at the highs of the session. Steve Grasso, where do you think we go from here?
Well, I think the market probably moved lower as a whole. But if you look at the coal stocks caught a bid about a week ago. And if you look at them specifically, ACI, BTU, ANR, they were rallying ahead of the China headline. I think they'll be strong. I think the market as a whole probably goes lower this week.
Okay, let's call the close, go around the horn. Tim Seymour, what do you say?
Me, sell equities and buy treasuries.
Oh, Tim, go ahead.
The price action's fine. I'd stay flat this market into the close, however.
Grasso.
I still don't like the market. I'd be selling equities.
Joe.
I think the ag space is underperformed, and a name like Coca-Cola is underperformed as well. Both those places you could be now.
All right, that does it for us.